there, everybody. I've had a lot of requests lately to talk about corporations, LLC versus C-Corps, and what entities you will need to operate with. So I'm going to cover that on this lesson, but before I do, my disclaimer. I am not an attorney. I do not render legal advice. You should seek an attorney whenever you're dealing with entities or any kind of legal documents. And in fact, you shouldn't listen to a thing I'm about to tell you. I'm going to tell you what I do, and then you can determine how it applies to you. What I'm going to show you is simple enough for anybody to set up, and exactly how I ran my business for a lot of years, but you're going to have to decide with the help of a professional on how you want to set it up, because when I get beyond the point that I'm about to show you, you probably are going to need some help, because truthfully, if I lined up 10 people against the wall, they would all have different entity structures because of the different things going on in their lives. So let's start with, I can tell you what, let's go over here and start with the difference between an LLC and a C-Corp, because I use both. Most commonly used entity today is the LLC when it comes to business. Almost all real estate investors are going to use LLCs, including me, and some of them will use C-Corps, including me. So let's go through the differences so you can understand what the main differences are, and then you can decide what you think fits best into your model. An LLC has advantages and it has a disadvantage as far as I'm concerned. The biggest disadvantage to an LLC in my mind is that the taxes all flow through to the members of the LLC. And that's not necessarily good. If my company goes out and makes a lot of money, then that comes right on through to me personally, and then I get taxed on top of my other taxes for all the other things that I'm doing in my life. Sometimes that works out great, sometimes that doesn't. I'll tell you why I use C's in a moment, because that somewhat counters that. With an LLC, you have no choice. Your corporate year end is the 31st of December, and you can't change it. And when you take money out of an LLC, you take it out as distributions. That's an advantage. You can just write yourself a check and call it a distribution, because all the money that comes in, or the profit that comes in your LLC, is going to get taxed in your personal tax bracket anyway. So how you disperse the money really doesn't matter that much. You can call it a distribution. And you're going to get taxed. The LLC doesn't get taxed. The net income from it flows through to the members on a K-1 that your accountant will prepare at the end of the year, and that K-1 will be part of your personal income tax 1040 return. So whatever income comes in here is going to get taxed in the bracket that you're currently in. An LLC has a manager. A C corporation has a president, vice president, secretary, and treasurer. So when you hear the word manager, you know it's an LLC. When you hear president, you know it's a C corporation. Now, the C Corp, you can choose any year end you want, and that might be an advantage to you. It's one of the reasons why I chose a C Corp, and in fact, my entity that I use to buy and sell houses is a C Corp, and you'll see why here in a second. There's no flow through. Whatever money I make in my C Corp does not affect me personally on my tax returns. It has nothing to do with me, actually. This is a totally different entity. A corporation is not you, even though you may own it. It has its own tax return, it has its own bank account, and the income does not affect you personally in any way, shape, or form, which is good to me. It's an advantage to me. I want to know that I can operate a business and not have to worry about it making money and coming through to me personally. I can deal with it on a corporate level, and here's why. In a C Corp, the first $50,000 of net operating income is only taxed at 15%. Well, that's lower than my personal tax bracket. I certainly hope it's lower than your personal tax bracket, because if it isn't, you need to make more money. So I'll make sure that the income at the end of the year in my C Corp is small. If I have a profit there, I will pay myself a salary or a bonus and get the money out of the C Corp. And you need to understand now that the last thing you want to do is take dividends out of a C Corp. And here's why. If you call the disbursement to you a dividend, that is not a taxable event to the corporation. They do not get to write that off, but it is taxable income to you. there's where you get the term double taxation. If you call it a dividend, the corporation doesn't get to write it off, but you get to pay taxes on it anyway. So in effect, you pay taxes twice on the same money. So no dividends out of a C-Corp. Comes out of salary or bonus. So let's say at the end of my corporate year, let's say my corporate year is June the 30th, which I get to name. In June, I'll take a look and see how much money this thing is going to net. And if it's going to get me above the 15 or the 25% bracket here, I'm going to make sure that I take the money out of there and bring it into me personally so that my taxes are down at 15 to 25%. From $50,000 to $75,000 net operating income, the bracket is 25%, which is probably still lower than many of you watching this lesson today. Don't forget though, with a C-Corp in many states, you have sales tax for the state on top of the income. In Florida, for example, we have to pay 5.5% to the state on the net operating income of this C, whereas in an LLC, there is no state tax. So, you know, you got advantages and you got disadvantages. You have to weigh whichever works best for you. From an asset protection point of view, either one of them, as far as I'm concerned, are fine. You will hear people say that there's more protection in the LLC. Perhaps there is, but honestly, I think you got all the protection you're ever going to need regardless of which one of these two entities that you use. Now, these are easy to set up. I mean, they're not difficult. Anybody can go online and set these things up. So it's not setting them up that I'm worried about. It's managing them, and that's where my friend Lee Phillips comes in. It's one thing to open an entity, but if you don't do it correctly and take care of the details that you are expected to take care of as the owner of a corporation, like minutes and consent and all of that, and run this thing like it's a real business, then you don't really have a real business in case you ever get attacked. And of course, the last thing you ever want to do is mix money here. We do not mix money. If you start mixing money and anybody comes after you, they can easily make the case that this is just an alter ego of you. So you have to run these things correctly. In fact, Lee Phillips will be at our summit coming up in Orlando in September, and that's why he's coming, to make sure that you understand how to run one of these things after you've formed it. And of course, he will make a good case that even your operating agreement that you use to form this with has to be written a certain way, because most people have no idea that the operating agreement they're currently using can easily be pierced if somebody comes after them. So for right now though, you can, if you need an LLC, you can open up an LLC. You can call one of the companies that form them, like Company Corporation or Business Filings Inc. Go online and there's a whole page of companies that will form them for you. Or you can go to places like LegalZoom or any of those places and form your own corporation. But don't stop there. Make sure you understand what you need to do after that. All right, let's move over here. And let's look at the entities that I think you're going to need to operate a business, buying and selling houses or buying and keeping houses. Most people have a flipper LLC designed to flip properties in. This is not designed to hold properties. As the name sounds, it's designed to flip properties. I use a C-Corp here for reasons I've just described. Most people use an LLC. Either one will work just fine. Please note that this entity is designed for properties you do not intend to stay in. In other words, tenants do not belong in this entity. This entity is to pay your operating cost, and truthfully, it will pay your operating cost of all your businesses. It literally will pay your operating costs of your keeper entity here. It will not make monthly payments on houses unless they're sitting in here being ready to sold for cash, but it will pay for advertising, for to find buyers or to find sellers and to find buyers, and all the other costs of the labor and your Pat Live bill and your VA bill and all of that. All of that gets paid out of here. And your salary gets paid out of here. You should take a salary out of this entity. And when I get folks into business management, I always tell them the least you're allowed to make is $5,000 a month as a salary to come out of this entity right here, because it is one of your biggest operating costs, and that's pay yourself. Pay yourself first. You're probably your biggest expense, and justifiably so. Who would want a business that can't even pay you? So if this business can't pay you, then you're not operating the business. You're letting the business sit there stagnant, and you're not making it create enough income to pay you. The whole goal is to have this entity pay you enough money so you don't have to work anymore, And then of course to get it all on autopilot as fast as you can. So if you're going to be doing wholesale deals, or axe deals, or rehab deals, you probably want to do them in this entity because you're going to exit. There's no tenant going in the house while you're still in the property. Now on an axe deal, of course, the tenant's going in the house, but you're assigning your contract, so you're out of the deal. Therefore, it's raw, pure, taxable income. All the income in this entity right here is short-term capital gains. You do not get long-term capital gains here because you are not going to hold the properties for more than a year. So you're operating this entity as what it's designed to do. It's designed to be a dealer-type entity that buys and sells, does not invest. It buys and sells. It creates raw income to pay the expenses of operation, and it is this entity that pays the cost of you acquiring the keepers that go in this entity. This is probably going to be an LLC as well, and this is the one, if you have tenants in the house, then they belong in this entity. If you're putting a lease option tenant buyer in a house, it should go here. Anytime you got an income stream coming in and a payment going out, most likely, it goes in this entity. So if I put a tenant in it, it goes here. If I don't put a tenant in it, it goes here. Now notice these LTs up here. That doesn't stand for lieutenant, it stands for land trust. Okay? So how you take title is very simple. Let's suppose I'm buying a property to rehab. Then I would buy it in a land trust. The documents are right on your Gold Club site. You have the trust agreement and the warranty deed to trustee right on your Gold Club site. I'll buy it in a land trust, but the beneficial interest of the land trust becomes the flipper entity. Beneficial interest is the flipper, but I'll buy it in a land trust. And in fact, you need another entity to be your trustee if your flipper LLC is the beneficial interest. Just remember this, the beneficiary and the trustee cannot be the same. The trustee must be different than the beneficiary. So if this entity is the beneficiary, you could always use this entity as the trustee for these deals. You can use this entity as a trustee for these deals. Let me say that again, because I know you didn't get it. Okay, if I intend to keep it, and I'm buying it in a land trust, I can't make this entity the trustee because it is going to be the beneficiary. So I'll make this entity the trustee and this entity the beneficiary of each of these land trusts. Each of these will have a tenant in it. So I'll be collecting rent and paying out rent out of this LLC. I'll be making payments out of this LLC. I'll be doing any maintenance directly related to the house. Remember, this entity only pays expenses that are directly related to the house. None of your operating costs. So this is another K1 going to your accountant at the end of the year, and this will eliminate the need for all of those schedulees in your tax returns. You know, that schedule with a property on it and all of expenses and income. You're doing that by putting them all in one great big pile here called an LLC, and then that is a tax return all of its own. So this entity, both of these entities will have tax returns, both of them will have EIN numbers, and both of them will have bank accounts. One for keepers, one for flippers. So by putting the title in a land trust, even the name of this LLC doesn't show up on public record. Nobody knows who the beneficial interest is except you, because it's in that land trust agreement in your filing cabinet at home. So you got each property in its own land trust. You don't have all your eggs in one basket. If something happens on one of these properties, now only that property is at risk. So I hope you got that. If you didn't get that, go back and listen to this again, put it in slow motion, and it'll gradually sink in. So all you need to do for now is think about this. I need an entity to do business in. I need another entity to hold properties that I'm going to put a tenant in. And if you get that far and understand you want to take title and land trust here, you're done. And honestly, that's probably as far as you need to go as far as your operation goes. Now, you're definitely going to need a whole lot more when it comes to estate planning, and probably some additional asset protection things as well. You're going to have to get with your attorneys on this. In fact, you probably should talk to Lee about it when you see him at the convention. But you're going to need a living trust, one for you and your wife. You're going to need an insurance trust, so that when you die, your insurance Your insurance proceeds do not go and get taxed or go to your to where you don't want them to go, like to the state. Plus, you're going to need a thing called a pour-over will, and probably 2 or 3 other documents down here, so that all your assets up here you've already decided where you want them to go once you die. And I'm not going to get into that right now, but why don't we just get this done first, if this is the route you choose to take, and then we can worry about all of that later, because you're going to have all you do get through this lesson and understand it first. So I think that's it for now. If you have any questions on this stuff, and I'd be shocked if you don't, go ahead and submit them to Elliot, and I'll fire you right back the answers as fast as I can. So that's entity structuring simplified. And before I go, are you registered for the convention yet? Look, you might as well get on the phone and get registered, because I'm going to harass you till you do, so why don't you just get it over with. By the way, we have 69 rooms left at the Embassy Suites. 69. We checked yesterday, and they will be gone probably within the next week or so. So if you want to get on the Embassy Suites and you want to get the free breakfast in a $99 room in a cool hotel with the rest of us, you better get registered so you can get your room booked. And if you look on this last Friday's weekly newsletter, you'll see we've taken time to go through several major cities in the United States and figure out what's the cheapest airfare we can find online to get you from that major city to Orlando. You'll be surprised how cheap the rates are. Orlando is the cheapest city in the country to buy tickets for airlines, so it wouldn't cost you much to come. So go ahead and get booked. Get booked. We'll talk about more on this when we get down there. Lee will be there, and I've got several classes that I'm working on right now as well that I'm creating just for that event. And incidentally, we've already picked out the golf cart. It's a beauty, and I think we got the truck almost picked out as well. Somebody's going to win a great truck. So look, go get registered right now. RES 2014. Or call our office at 800-567-6128. See you next week.